U.S. Energy Information Administration expects the U.S. to churn out about 8.6 million barrels of crude oil per day this year, a decrease of about 9% from 2015. The EIA said this week it thinks the price of West Texas Intermediate oil will average about $40 a barrel in 2016 and just more than $50 a barrel next year. But the government agency says that expectation comes with a high degree of uncertainty. We spoke in March with University of Nebraska-Lincoln Ag Economics Emeritus Professor Dennis Conley about the outlook for gasoline, and this week we talked with Dennis again to learn why it's so difficult to forecast the path ahead for the world crude oil market.
Jeff, it's complicated because there are many producers in the world of crude oil. You have the three major countries are Saudi Arabia, Russia, and the United States. They're the big producers. And then you have some other producers that are still significant, like Iran, Iraq, Kuwait, and so on and so forth. But there's a lot of them there that are producing.
Why is it important to focus on the ways that these different countries are producing?
It's interesting because we tend to think of market economics driven by private industry, but around 80% of the crude oil produced in the world is by state government enterprises. So Saudi Arabia, Russia, Venezuela, Iran, Iraq, Kuwait, and others, they're all state governments. The United States, on the other hand, the production here is in the private sector. So they're subject to market economics. But when you're a state government enterprise, not so much so, if anything, when their revenues go down for their crude oil production and sales, they want to actually produce more crude oil to be able to finance their public expenditures in their countries. And it's like agricultural producers in Nebraska. Price of corn goes down, we want to produce more so we can sell more to keep our revenue at the level we like.
How has output affected prices? And then we'll talk about the alternative.
We recently looked at gasoline prices at $3.50 a gallon in the past years. And gasoline prices are largely determined by the key ingredient of crude oil that goes into that gasoline. And so when crude oil prices were up around $90 to $100 a barrel, that's when we saw $3.50 a gallon gasoline prices. Now crude oil prices are around $40 to $45 a barrel, and that's why we're seeing $2.25 a gallon gasoline prices.
Is there an alternative to that question? Have prices impacted output, going back to that question about private versus public production companies?
Yes, it has, and the way to look at it is that when the price of crude oil dropped from this $90 to $100 a barrel range down to actually $30 a barrel, and earlier this year we were all watching, when is gasoline going to go below $2 a gallon? It happened when crude oil was $30 a barrel. Well, the producing countries have said, we're going to continue to produce more and more crude oil rather than cut back to try to hold prices up. OPEC has had meetings to try to constrain supply, to increase prices, but those meetings, they don't come to an agreement. And so countries like Saudi Arabia say, we're going to produce more and more and more crude oil in order to generate the revenue, even though the prices are low.
What's the outlook over both the short term and the long term for crude oil?
The short term is that the expectation is that the price of crude oil for the rest of this year will probably stay in this $40 to $50 a barrel range because of what Saudi Arabia is doing. They're going to increase their supply of crude oil, add 1 million barrels per day. Iran is trying to do the same thing, add another 2 million barrels per day, and other producers, state government enterprises. The question is, how much does that get offset by cuts of production in the United States that's subject to market conditions? But the outlook is $40 to $50 a barrel, which means gasoline prices probably in the $2.25, $2.50 range for the rest of this year. So that's the short range.
And the long-term outlook?
The long term is complicated. And it's complicated because of public sector or government entities that produce crude oil versus private sector entities. The International Energy Agency, which is responsible for keeping track of world energy, world crude oil supplies, et cetera, have produced a world report that says out to 2020, they expect these supplies to tighten up. They expect the growth in supplies to diminish, if you will, to decline, ending stocks and carryovers will subsequently decline, and that will bring then these prices of crude oil back up into the $60, $70, $80 range, and with that would be gasoline prices up around $3. Now, I'm an old elephant that has some memory. You guys are young tigers. You and Curtis are young tigers. I go back to 1985 when the oil minister for Saudi Arabia said, we're no longer going to hold up the crude oil prices for OPEC. We're going to dump our crude oil into the world market. What happened within 6 months is the price of crude oil went to 1/3 of the price it had been at that time. What I hear now from Saudi Arabia as well, from the oil ministers, is that they're going to continue to add crude oil to the world supply. So as Mark Twain says, well, history doesn't repeat itself, but it rhymes. So I listened to these comments, and in my own personal opinion is that in the next 4 to 5 years, by 2020, we're still going to see very ample crude oil supplies, and my expectation would be $40 to $50 a barrel. Gasoline prices probably in this $2.25 to $2.75 a range. That's good for the U.S. economy, and that's good for Nebraska agriculture.
You can see our previous conversation about the outlook for gasoline prices in the March 18th episode of Market Journal.